Hello and welcome to another webinar on different financial topics. By way of introduction, my name is Alexei Schwartzman. I'm a certified financial planner and I've been involved in the financial industry since 2008. We will talk a little bit more about the services that we provide to clients later today, but we are focusing on the topic of building your own investment portfolio. And just a couple of administrative things. If you have any questions during our presentation, put it into the chat window. And we will be addressing questions sometimes throughout the presentation and sometimes depending on the questions that arise. We do have a few minutes allocated for Q&A towards the end of our presentation. And what we are going to do is today we're covering the topic of building your investment portfolio. Just before we start, I wanted to remind everybody that this is not financial advice. This is not legal advice. Even though I'm a financial planner, we will be discussing different investment strategies or a few investment strategies. So everything that you hear on this call, that doesn't mean I recommend a certain stock or a certain approach when it comes to investing. On the investment side, we provide or we use different funds. Mutual funds are provided through Investia Financial Services. On the insurance side, we are licensed with multiple insurance companies, and we use whatever company is going to be best for our clients. On our today's agenda, we'll briefly talk about different kinds of investments. So we'll talk about what is an investment. We'll talk about a spectrum of investing. We'll talk about the issues of risk and return. We'll talk about different elements that you can use in your portfolio, with the question being, is it going to make your portfolio stronger or is it going to make your portfolio weaker? And then we'll talk about how to succeed with portfolio building. So one of the questions that I generally ask when it comes to investments, what is an investment? If I was to ask everybody on the call, what is an investment for you? And one thing you'll quickly discover is that for everybody, the definition of investment is a different story. For some, it's a bank account. For some, it's real estate. For some, it's as somebody who said it's a bar of gold. And there are many different kinds of investments. Ultimately, we'll look at it from a perspective of one of the most successful investors, Warren Buffett, who said investing is the process of laying out money today or now in order to receive more money in the future. So anything can be an investment. From that perspective, I don't know if any of you have done this, but you may or may not know you can invest into art. There are lots of people who buy paintings with the idea that they're going to appreciate in price, and oftentimes they do. And there is a way to measure how much you are going to benefit from investing into art. There are some individuals who invest in wine. I don't know if any of you on the call are doing that. But this is a wine index. This is up to about 2018, 2019. And by the way, since then, the wine index didn't do particularly well. But there are a lot of things that can be an investment. I had one individual who was investing or buying guitars. When I say guitars, we're talking about very high-level guitars, very expensive guitars, very rare and precious guitars. And his strategy was when he was going to retire, he was going to sell all these guitars and live happily ever after. That's the idea. Whether or not that happened, I don't know, but that was the conversation we had at the time. So when you look at different asset classes, you'll realize that there are a lot of different things you can be investing, arguably should be investing into, and this ranges, going from currency and different kinds of currencies, to fixed income, which we'll talk about in a few minutes, to equities, which we'll also cover. You can be putting your money into private equity, into real estate, into infrastructure, and there are collectibles, and everything you see on the slide. By the way, there are many more things, of course, in the world that you can be investing into. But the question becomes, if you were to build a portfolio that you would want to grow in the future, what should you be investing into? And that is the topic of today's conversation. In order for us to figure that out, we are going to discuss the topic of profit and loss, or risk versus return. You may have seen this chart, or there are many different versions of this chart. So on the bottom, we have a degree of risk or risk. There are several ways of measuring risk, but there are certain things that are risky and certain things that are more risky and certain things that are less risky. Okay, so if we were to start on the bottom, let's say, so there is cash. Cash has virtually no risk except for inflation. Cash actually does have a risk because inflation is eating away at it. Nonetheless, cash is a very safe thing. But then you have government bonds, you have GICs, you've got bank accounts, you have corporate bonds, you have different types of shares. And then as we move along the continuum, we start getting into more complicated things. We talk about gold, real estate, commodities, crypto, etc., etc., etc. The list continues. But what you will take away from this slide is that as the risk element goes up, the potential for a return goes up as well. So you could potentially have all of your money sitting in cash or in a bank account. And by the way, I do have people call me saying, hey, Alex, I have X number of dollars sitting in my bank account, and inevitably ask, oh, how much are you earning? And sometimes they're earning nothing. And the question is, well, what should I be doing with this? And the answer is pretty complicated, but there are ways to keep your money invested with no risk, but the returns are going to be very low and probably not high enough to keep up with inflation, probably. But as you can go up, continue along the spectrum, you can find things that are going to give you some return. And generally, when we create a portfolio for clients, we categorize some of these things that are low on the return scale and low on the risk scale. We call them fixed income for a few reasons, which we don't really need to get into. So, but when I say fixed income, think about fixed income as being things that do not grow, but things that do not fall. So things that have no risk, but no return as well. On the other side, we've got something called equity. Equity has a potential of returns, but there is a degree of risk. And the higher the risk, the more the potential of return is going to be. Now, imagine we can create 3 portfolios, okay? One portfolio is made up 100% of fixed income. And just to remind you, so fixed income are these things that are very stable but not growing. Imagine we can create a portfolio that's made up of 100% of equity. Okay, so equity, we're talking about these things. And yes, by the way, they do overlap. Some things are here, some things are there. But here's portfolio number 2. Portfolio number 3, imagine you can do both of these elements. And what we find is that by using both of these elements, your returns are generally going to be better, with a few caveats, okay? And in order for us to understand that big picture, we need to come back to something known as the modern portfolio theory. What's the modern portfolio theory? So this is a theory that came out in the 1950s by Harry Markowitz, who he didn't just look at the returns of a particular asset. He looked at the returns of a particular asset in relation to risk. And when you look at investments that way, it basically means that a particular asset, so in this case, asset B happens to be equity on this chart, so they're called stocks, so stocks and equity. So in the long term, asset B is going to do fairly well because historically we know equity does well. But in the short term, by adding a bonds component or a fixed income component, as you saw from my graph, we are actually lowering the risk, and we have the portfolio perform at a better rate. What does that mean? That basically means that by introducing certain elements to a portfolio, and some elements that might be counterintuitive, some elements that are not growing as quickly as other elements, by adding those elements into your portfolio, you are, in the long term, you are making the portfolio more stable. And arguably, yes, maybe your returns are not going to be as high, but your portfolio is going to perform better just in terms of how volatile it is, how much it jumps, how much risk it can accommodate. that's the idea. And what you find, we would expect the curve to be like a straight line. So the riskier things are, the more you're going to earn. Yes, to a degree. And there's something known as the efficient frontier, where you can get to the optimal level of return depending on the degree of risk in your portfolio. So let me ask you this question. On your screen, you will find 4 portfolios. Okay. And I'm going to ask you this question. Which portfolio would you invest into? Let's say you have $1,000, $100,000, $1,000,000, doesn't matter. But you're going to invest into one of these portfolios. So in the chat, if you can put, would you choose portfolio A, B, C, and D? And portfolio A in a particular year can go up by 13%, or it can go down by 2. Portfolio B up 20, down 7. Portfolio C up 28, down 13. Portfolio D is up, you could be up 37%, but then you could also lose about 20%. Which portfolio would you choose given this scenario? So in the chat window, if you can put A, B, C, or D, okay, great. Fantastic. So one thing, okay, so we have somebody, great. We have some people who would use A or B. We have some people who would use C. We have somebody who would use a D. Wonderful. The idea is that these portfolios have different purposes. And your degree, your degree of how comfortable you are with markets also varies. So let's say if you are 25, or maybe let's say you just graduated from college, you're in your early 20s, you don't have a family, you just got your first job, then potentially you can tolerate more risk. Okay, while if you are, let's say you are 60 years of age, you are retiring in 5 years, you cannot afford to have a 20% drop in your portfolio. So your investing strategy is actually going to be quite different, quite less volatile. Okay, and if we were to look at, let's say, the approximate breakdown between the equity and the fixed income elements of this portfolio, you'd note in portfolio D, 100% equity. Portfolio C, it's 80-20, so 80% equity, 20% fixed income, and then 60-40, and then 30-70. So portfolio A has a lot of fixed income and some equity. And by the way, it's the equity that's going to drive that loss. Okay, it's not the fixed income. Fixed income, you virtually, you're not going, in most situations, you're not going to be losing money on fixed income in most situations. But it's the equity element that could potentially bring you down. But it's the equity element that will push you up as well. So when we talk about S&P 500, okay, and some of you may not know what S&P 500 is, but for those of you who are not certain, S&P 500 it's a stock exchange. It's a US. If you were to take 500 companies, 500 largest companies in the United States, and if you were to break them into certain classes, so for instance, real estate, utilities, healthcare, and if you were to look at a performance of a particular class, you will find this very colorful chart. I really like this chart because it shows you how difficult it is to be able to predict how you're going to do in a particular year. Why? Because you have certain companies that are going to do well, and then you have certain companies that are not going to do well, and nobody knows which ones are going to be which ones. Okay, and let's just take one year as an example. I'm gonna pick on the year 2020. Does anyone know, or can anyone tell me what was special about year 2020 and why year 2020 is never going to leave our memories? So if you know, you know. If you don't know, you will know very shortly, because year 2020, yes, thank you very much. Year 2020 was the year of COVID. So in the year of COVID, when we look at, well, what happened? Well, the best performer was consumer discretionary. What's consumer discretionary? Consumer discretionary are things that you need on daily life, okay? Toothpaste, toilet paper, and of course there are we're not going to be joking about toilet paper and COVID, but things that year of COVID, there were a lot of companies that did particularly well. Why? Because the economy basically came to a standstill. Okay, so consumer discretionary companies that were involved in consumer discretionary, they did well. Why? Because we need toilet paper, we need certain things to live. And information technology did well, communication services, but let's say real estate was fairly flat. Energy did not do very well. Healthcare did pretty decently, did about 18%. Why? Because year of COVID, healthcare is, if there is one sector that you would think did well in the year of COVID, that should be healthcare. In the year 2022, for instance, so a couple of years later, it's a very different story. Year 2022, by the way, was not really good for the stock markets. I don't know if anybody can think back to 22 what happened, but I'll tell you. So in 2022, there is the Russian invasion of Ukraine, and the markets suffered because of that. And one of the things, so 2022, we do see a big jump in energy companies. Why? Well, for obvious reasons. Whenever you have Russia tied in a war, that's going to affect the supply of oil. That's going to affect how much energy company are going to be earning. And that creates, of course, a lot of uncertainty. So this is one sector that did really well. When you look at other sector, consumer staples, healthcare, everything else was down. Okay, 30% down for information technology. Communication was down 30%. So 2022 was not a good year. But what you'll find by looking at this chart is that different years, there are different sectors that are impacted by different situations. And it's very difficult to predict. So year 2025, for instance, or 2000, I don't have 2008 here. So very difficult to predict. In 2023, by the way, information technology did really well. And information technology, and by the way, information technology over the last few years are going to perform really well. Why? Because AI is now on the horizon. So in the last couple of years, what we've seen is a disproportionate growth due to whether it's the Mega 7 or now the Mega 10. So some of the biggest IT companies are driving the market. It's the Amazon and the Meta and Google and Nvidia, et cetera, et cetera. So they're driving the market. Many other companies are not doing well. So the question is, well, how do you use that information in order to build your portfolio? And the answer is, well, one of the options could be, and I'm not sure, nobody's asking you, but one of the questions sometimes says, hey, what if we were to invest in all of these things? Okay, and that could be a pretty decent strategy, because when you invest all of these things, so just the S&P 500, so that's just the top US companies, because you're exposing yourself to many different sectors, and some are going to increase, some are going to decrease, some are going to benefit, some are not. And then there is another element or other elements that you can add to your portfolio to make it stronger. Okay, for instance, do you think your portfolio would do better if you were to add some gold to it? When I say physical gold, I actually mean physical gold. You don't have to buy physical gold, but you can, if you wanted to, you can buy it through a broker, you can buy it through a fund. Because when you look at the performance of gold, let's say this is in US dollars per ounce in the last, let's say in the last 20 years, especially in the last couple of years, it did really well. And of course, the minute gold starts doing well, there are all these stories about, oh, how much you would have earned if you invested in gold. Would you make your portfolio stronger? Oh, by the way, this is a comparison between S&P 500 and gold. Okay, why would you want to use gold? Because if we were to go back, let's say let's take year 2022. For example, and by the way, this is in US dollars. So the dark blue is S&P 500. The light blue, or this other gray color, that is gold. Okay, so in 2022, Russian invasion of Ukraine, the markets are down. S&P is down about 17%. Let's just say 17, 18%. Gold is down about 1%. So by adding some exposure to gold in your portfolio, are you going to make the portfolio stronger? You can make the argument then yes, because historically gold and S&P 500, they are inversely related, or they have an inverse correlation, which means when one goes up, the other goes down, and vice versa. And we do see this in 2022. We see this really strong, big loss on S&P, very little loss in gold. We see this in 2021, big gain in S&P 500, a loss in gold. We see this in year 2015, big loss in gold, small gain in S&P. So it's not a perfect relationship, but it generally works. So it's not a 100% correlation, but it generally works. Okay. Here's another sector that is on the horizon for a lot of individuals: crypto coin or crypto. So how many of you, or do any of you, have exposure to crypto? Okay, because I mean, yes, we can go back to 2010, 2011, when it was worth 9 cents and 10 cents, etc., etc. But most people haven't started really investing into it up until the last maybe 5 years. So the year 2020, by the way, we are starting to see growth. I remember why? Year 2020, COVID, a lot of people are stuck at home, nothing to do. All of a sudden, you have an opportunity to learn about the markets, buy certain things. So that's when Bitcoin really started increasing in value. Okay, and then back and forth with lots and lots of variability and big drops, but big increases. So if you were to add a certain element of Bitcoin to your portfolio, the question is, would it make it stronger? And in the last 5 years, we see that the answer is yes. By adding cryptocurrency, or Bitcoin in particular, to your portfolio, you would actually make a stronger portfolio. It's the same idea, because the correlation between S&P 500 and Bitcoin it's positive, but it's not very strong. And by adding different assets that are not necessarily correlated to your investment, you are actually making the portfolio stronger. Why? Because you're lowering the degree of risk in the portfolio. We can also talk about alternative investments. Alternative investments, they've been around, but they're really starting to shine, so to speak, now. Once again, because you're looking at things that are not correlated to your main investment, which is going to be S&P 500, or it might be the Toronto Stock Exchange, or it might be NASDAQ, which is another stock exchange in the United States. So when you look at stocks versus other elements, so for instance, real estate, I don't know if any of you on the call have real estate, but oftentimes you would want to have real estate as part of your portfolio. And when I say real estate, most people automatically think houses, not just houses, but let's say I live in a house, I live in an apartment, here, real estate. When I say real estate, it breaks into many different sectors. You've got commercial real estate, you've got office real estate, you've got warehouses, you got data centers, and for instance, office space, year 2020, year of COVID, actually, and since 2020, obviously nobody wants to work in the office, and we saw this. So office as a subsector of real estate, office has been hurt a lot. Okay, not to say that it's not going to recover; it will recover, but you will have some sectors that are performing, some sectors that are performing poorly. And by adding these elements to your portfolios, you are actually going to make your portfolio stronger. Okay, now these are, so real estate, once again, we're talking about many different subsectors. When we look at private equity, so these are loans, let's say, or private equity, you could have a company that's buying other companies, and you're buying shares of a first company. Then using hedge funds, using real assets. So real assets, we're talking about diamonds, we're talking about precious metals, etc. So all these private credit, these are loans or mortgages. You can have all these elements will ultimately make your portfolio stronger. Okay, and just as an example, imagine if we were to look at the S&P 500. So S&P 500, you now know what that is. And let's say you invest $100. Yeah, let's say no, not 100, $10,000. Let's say you invest $10,000 into S&P 500 3 years ago. Okay, now there's going to be fluctuations. Okay, and when I say 3 years ago, so you are, keep in mind, if you remember, we talked about year 2022 was not a good year for the market. Okay, so since then, the markets have been mostly up, except for January, well, up to about April of this year. So early in this year, it hasn't been up. Why? Tariffs and other economic factors. But so Trump taking leadership in 2025, and that brought certain economic uncertainty. And the markets didn't do so well as of, let's say, February, March, April of this year. But we've since recovered, or mostly recovered. But the idea is, if you were to put $10,000 into S&P 500 today, maybe yesterday, you would be sitting at about $18,000. Okay, which is actually pretty good when you think about you almost doubled your money in 3 years. That's actually a pretty decent return. Keep in mind, once again, we're coming out. So 2022 was a low year. So you're buying things at the low, and now you're only seeing the growth. Now, what if we were to take the same portfolio? What if we were to add two elements to it? Okay, one element is going to be gold. One element is going to be cryptocurrency. And let's just say, for the sake of argument, right now, this portfolio is 100% S&P 500. What if we were to do 80% S&P 500, 10% cryptocurrency, 10% gold? Would that make the portfolio stronger? How many of you think yes? The answer is yes. That will make your portfolio stronger, as you can see here. So the blue one now, S&P 500, and then the red one is S&P 500 at 80% with Bitcoin and with gold. So what you see, if you would have invested, now keep in mind, we've only really seen the growth of Bitcoin in the last maybe 3 years, or since 2020, that's when it started. We've only seen the growth in gold in the last year. Okay, not last year, but specifically we saw it in the last year. Since Trump's tariffs, gold really did well. So the same $10,000 invested in 2022, you would be now looking at almost 20,000 years if your portfolio had these two elements. Okay, and let's, for the sake of argument, bring in a third element. So let's say we're going to bring in some real estate into the portfolio. Now, the bottom, the yellow line is 100% S&P 500. The blue line is your portfolio with 70% S&P, 10% Bitcoin, 10% gold, and then 10% real estate. So these are real estate income trusts. And then the first portfolio is the S&P 500, 80% in Bitcoin and gold. So our first portfolio, the one that we just covered, yeah, it still did pretty well. But adding a real estate element to your portfolio, number one, it did give you some returns, better returns compared to S&P, but not as good as just having Bitcoin and gold in your portfolio. What does that mean? So real estate as a sector, it's not necessarily correlated with S&P or with gold or with crypto. It's got its own schedule. It's got its own ups and downs. And comparing to Bitcoin and gold, you did not do well, but we're only looking at a 3-year time frame. Okay, there will be years, and by the way, real estate market, especially those of you who are in BC or in Canada, the real estate market is not doing particularly well. And in fact, I think we that's a whole other issue. And if you want to join our real estate webinar, feel free to do so. But just when you look at a longer term, if you look at a longer term, having different elements in your portfolio does make it stronger. The only question is, what are the elements and how much should you be allocating to these elements? Okay, so part of your strategy is diversification. So not just putting money into equity, putting money into fixed income, putting some money into whether it's gold or crypto or healthcare or real estate or other sectors that may not necessarily correlate well with your asset. And this is going to be probably the busiest chart you're going to see. You've seen that they're called index charts. You may have seen it. And the idea is the following. Imagine you were to go back in time, or have the longevity gene. And imagine you invest $1,000. You go back to 1934. You invest $1,000 into different things. One of them could be, let's say, U.S. stocks. So U.S. stocks, you're talking about S&P 500. One of them would be growth portfolios. One of these would be Canadian stocks versus balanced portfolios, and et cetera, et cetera. So the question is, let's come back to the year 2024. How would you have done? Okay. And let's just zoom in a little bit. So $1,000 invested. Now, keep in mind, historically, and you may or may not know history, ultimately, it doesn't matter. Many of you will know about the market crash of 1929. So 1929, huge market crash with pretty significant consequences for US and for the rest of the world, just economically because of that crash. Okay. Now, 1934, which is so you are starting to come out of the crash. So in a way, whoever did this chart, this is a good time to invest your money. Okay, 5 years after the crash. Nonetheless, your $10,000, and let's just assume that all the money gets reinvested, so you don't take any money out, and you keep it there for obviously a really long time. In 2024, you'd be sitting at $22 million if you were to put this money into a US stocks. If you were to put it into a growth portfolio, so growth portfolio would be an 80-20 portfolio, 80% equity, 20% fixed income. You'd be sitting at about 5 million. Okay, Canadian stocks, you'd be sitting at about 4 million. And then a balanced portfolio is about 60-40, 60% equity, 40% fixed income. And then bonds. So bonds and T-bills, actually, let's just say bonds, because you can use bonds to get the idea of fixed income. So let's say in 1934, you put $1,000 into fixed income, so safe things. Okay, well, now you would be sitting at about, let's say, $140,000 as opposed to, $5 million that you could have been earning in a growth portfolio. So to come back to the question, well, I get this question asked all the time. And the question is, Alexei, I have whatever, $1,000, $100,000, $500,000. What should I be invested in? Well, the answer depends. And the answer depends on what is it that you are trying to achieve. Because your investment strategy and the way you would build your portfolio would depend. Are you looking at retirement? Let's say you're in your early 20s and your retirement is not for the next 40 years. Or are you thinking of buying a home in the next 5 years? Or are you thinking of putting your kids into university in 10 years? So your investing strategy would depend on what is it that you're trying to do. And yes, you can use different elements, but even the same person, you can have multiple portfolios. You can have one portfolio that has, let's say, a gold element or gold, a certain percentage, or Bitcoin, or real estate, or healthcare. And then you might have another portfolio that's purely fixed income. So by mixing and matching different portfolios, you create an infrastructure to get you to your goals. Now, of course, your goals depend on you, and your goals will change. Like I said, if you are retiring in 5 years, your risk tolerance or your comfort with market volatility is going to be very different compared to you being in your early 20s, just finished college, just got your first job, no family, no kids, nothing to worry about. So when it comes to building a portfolio, what you do is, number one, you figure out what you want to do, what do you want to do with this money, and then you build a portfolio based on that. Strategy number two, diversify. So have different elements in your portfolio. Strategy number three, remember the portfolios A, B, C, D that we covered earlier? Well, those of you who chose C, for instance, may not be comfortable with the portfolio D, and vice versa. So when you create a portfolio, it's very important that you find, well, if your portfolio drops by, let's say, I don't remember the numbers, but let's say it drops by 10%, would you be comfortable? Some of you on the call would be, some of you would not be. So when it comes to creating a portfolio, you don't just look at how much you can earn. You look at, well, where do you feel most comfortable? Because you don't want to be, watching the stock market all the time. You want to create a portfolio and then let the market do the heavy lifting for you, or let your investment strategy do the lifting for you. And understanding different components or different elements of your portfolio is also really important. Why? Because by understanding the correlation between them, by understanding the future prospects. So Bitcoin, for instance, is a very, very volatile asset, but it's outperformed any other assets we've historically had. So should you be investing? Should you not be investing? The other thing we don't really cover in this webinar, but tax efficiency. It's very important. If you have an investment portfolio that generated 10% for you, are you happy? Yes, you are happy. Okay. Are you happy? But if you happen to be in the top tax bracket, which in BC happens to be 53%, so marginally every extra dollar you're paying 53% in tax, are you happy? Not necessarily. So the question is, can you find a portfolio where you generate as much as you can, but looking at tax efficiency? Because the wealthier you are, the more tax becomes an important element in construction of your portfolio. And the other, or the last thing that you need in order to build a successful portfolio is to stay invested. And those of you who invest, you pick a company, you pick a sector. Gold. Okay, if we were to go back to the gold chart, gold didn't really do anything for the last 6-7 years, but in the last 2, it went straight up. Bitcoin, 2009 up until about 2020, nothing. Hovering around. Yes, there are some lucky people who were able to buy Bitcoin at that time, but in the last, now it's hitting 120,000, and that's the thing. You don't know when it is going to. Well, nobody knows the future. Okay, so those of you who stay invested in the long term, yes, at some point you do need an exit strategy. Okay, if you're 65 and your portfolio is still very volatile, that's not a good way. Not a good thing to do. But staying invested is one of the reasons why people really succeed in the financial world. So having said all that, that is basically how we build portfolios. Okay, when I say we, so the company that I run, Schwartzman Financial Corporation, our business model is integrated financial advice. So we do investments, we do taxes, we do insurance, we look at financial planning, do retirement planning, and many other elements that make up somebody's financial success. And we also give webinars on different financial topics. And on the note of webinars, we do have a couple of webinars coming up. On August 13th, we're talking to financial planning strategies for small business owners. Then September, we're doing a webinar on advanced investment strategies. And then October, we're doing a webinar on retirement planning. And I don't know each of you on the call, how you found out about us, but you should be able to register for these webinars in the same location where you've registered for this one. If you would like to get in touch with us, here is the information. And what we are going to do is we are going to open up, feel free to post any questions in the chat, or if you'd like to unmute yourself and ask the question that way, that will work as well. And I believe we did have a couple of questions. Let me just quickly check.
Hey, Alexei, yes, you did have the one question earlier on in the chat about what is the best investment trading platform for self-investment. They said Bank, Wealthsimple, Questrade.
Yeah.
And that question was from Luth. How would you answer that?
Yeah, it's a great question. So for the most part, your trading platform doesn't really matter. Okay, every bank has a trading platform. BMO has BMO Investor Line. RBC has RBC Direct. TD Waterhouse. So everybody's got this. And for the most part, there is Questrade as well. It doesn't really matter which platform you choose, because you can buy S&P 500 through this one or that one or this one or that one. Wealthsimple is a little bit different. Okay, Wealthsimple is a company, they create portfolios for you. So what they do is they use different ETFs in order to create. So if I think you fill out a questionnaire, and then so they understand your risk tolerance, they understand a couple of things about you, and then they give you, okay, your portfolio should have 30% S&P, 20% this, 10% that, etc., etc. Okay, so Wealthsimple does it on your behalf. But if you're interested in trading yourself, so trading, you can buy shares of different exchange traded funds like S&P. You can also buy certain stocks. Okay, It's funny, I just had a conversation with somebody and we're talking about whether it's Tesla or Microsoft or Nvidia. Doesn't matter. But some people are interested in buying stocks. Some people are not interested. Some people don't want to do anything themselves. They just want to have like a robo advisor or a financial advisor who does the decisions on their behalf by understanding their goals, their risk tolerance, and creating a tax efficient portfolio. So the answer to that question ultimately depends on what is it that you're trying to do. Any platform. I mean, yes, I think Questrade. So I'll give an example. I think if you buy a share of something, not ETFs, because a lot of ETFs are now free. But if you were to buy a share of a stock through BMO, I believe it will cost you $9 every transaction, so buying or selling. But if you were to buy the same share through Questrade, it might be $4 or maybe even less. So depending. So yes, fees for transaction fees are a factor, but especially if you are buy and hold type of investment, it's really not a big deal, not a big difference. Other questions?
Luth said, thank you for that answer,
Yeah,
but there's no other
sure.
questions in the chat that have been posted.
In terms, I see there is a question of what types of services or consultations do you provide? So what we ultimately do is we meet with clients and we talk about what they would like to achieve. We figure out their goals or their objectives. And then once we know what those are, we create the financial infrastructure for them to get there. Okay, we use different portfolios, so we're not linked to any. So if you were to walk into RBC, for instance, to talk at RBC advisor. By the way, I have nothing against RBC. I have RBC accounts. I work a lot with RBC and their funds. RBC will only use RBC products for investments. Because we're independent, so we don't have any restrictions. We can use RBC products, BMO, CIBC, Dynamic Fidelity, McKenzie, etc. So when we create a fund, it has different companies in it. Okay. Ultimately, it doesn't really matter which company you use. That's the thing. So let's say an RBC balanced portfolio is going to be very similar to a BMO balanced portfolio, similar to a TD balanced portfolio. Why? Because a balanced portfolio has 60% equity and 40% fixed income. Yes, some years your BMO portfolio will be better, some years your TD portfolio will be better. But in the long term, they're all going to grow at about the same rate. Why? Because they're structured the same way. What we do is we use different elements. So we can use, actually, and for some of our clients, we do buy crypto part of their portfolios. We do buy gold, we buy real estate, we buy healthcare. So we have certain funds that are sector specific. And ultimately what we do is we figure out what the goals are. We create the infrastructure for it. And then that's basically it. And then we revisit once in a while. And for many of our clients, not all, but for many of our clients, we also do taxes. So once a year, when we talk about taxes, we review the investment portfolio and we talk about, so the tax structure or the strategy has to be really well integrated with the investment strategy because they work hand in hand, literally. And then we give webinars, and then if people need insurance, we deal with insurance. If people have questions about mortgages or buying real estate or selling real estate, we do all of the above. So we're holistic. And the next, this is interesting. So what is the lowest fund budget one of your clients invest in? What's the lowest budget, bro? So I think the question is probably, what's the smallest amount of an investment somebody can have in order to invest with us? we generally do not work with clients with less than $100,000. Having said that, we do taxes for a lot of people who are not our investment clients. So oftentimes we can talk about, when we do somebody's tax return, if they have questions about investments, we can recommend certain institutions or certain strategies where people, put money aside without using us. Okay, let's say we have access to high interest bank accounts. We have access to other types of investments. So sometimes it's not even done through us, but the person will build up their portfolio up until they can start using us. And then at some point they come to us and we help them. So I think the idea is oftentimes we can guide people without them being our clients. That's the idea. And as such, zero. There is no minimal investment with us. But our minimal investment is $100,000. The next question is, what's the difference between real estate income trust and actually buying a property? See, that is a wonderful question because they seem like they're both part of real estate. So it seems like it's a whole thing. They're worlds apart. Okay, why? Because an investment property, um, the factors that impact your investment property are very different from the factors that impact a real estate income trust or a real estate fund. Why? Because the real estate fund will have different sectors. Like I said, office space, commercial, it will have warehouses, data centers, etc. Versus, so when you buy a property, and by the way, us in BC, we want everybody to have real estate as part of their investment portfolio. If a person can afford to have their own real estate, beautiful. That's what we help with. If not, you can buy real estate income trusts or certain real estate funds. Because having exposure to real estate, as you saw in the presentation earlier, having exposure to real estate helps your portfolio. Okay, but what is the difference? So they're world apart. Having your own property, which depends on location. Now you're talking, do you have a house? Do you have a condo? Is your condo downtown Vancouver or is your condo in Port Moody? Okay, so the factors that impact the price of your condo in Port Moody is going to be very different from the price that impacts the portfolio of, let's say, commercial real estate downtown Vancouver. So very different things, even though they're both part of real estate. Really good question. Is it okay to time the market while investing? It's a great question. So timing the market, in my opinion, is very difficult to do. And maybe you need super smart people. Maybe I'm just simply not as smart for it. I don't believe in market timing. Okay, what's market timing? Market timing is, let's say the market is up now, and you say, I don't want to invest now. I'm just gonna, or real estate. People are sitting on real estate saying, Alexa, I can't afford now. I'm just gonna wait until the market comes down, and I will buy then. Possible, but realistically speaking, it's very difficult to do with real estate in particular, because with real estate, you don't know where the market is until about, I don't know, 2 months, 3 months after the fact. Because when you look at sales, when you look at, let's say, the average price of a condo downtown Vancouver in July, you won't know this up until about August or maybe even September, because it's all like when you look at sales retroactively. By the time this data comes in, you've missed the boat. And I do have one client who was exactly, he couldn't afford a place, and he said, no, I'll just wait until the market comes down a little bit. And 5 years later, we had the same conversation. He said, oh, I so wish I bought that place 5 years ago because now it doubled in price. Okay, and by that point he was priced out. He actually, by that point, real estate was growing much faster, and he, as far as I know, he still didn't end up buying the property. So that's the idea. Market timing is, in my opinion, virtually impossible. Okay, one of the strategies for people is if you can't afford to buy, using a strategy called dollar cost averaging. Dollar cost averaging basically means if you can't buy a stock, let's say you put $5 every month. So you buy $5 worth of a stock or $5 worth of, say, a fund over time. Because the dollar cost averaging does work, because in that $5, when the market is down, you end up buying more shares. When the market is up, you end up buying fewer shares. But in the long term, and you saw this from the big picture graph, in the long term, the investments go up. So I don't believe in I don't believe in market timing. I've personally never succeeded with it. I've tried many times, not smart enough. But there are certain strategies to still benefit from the market without trying to time it. If there are no other questions, I was going to mention that we're happy to, so once we have the video of this webinar, I'm more than happy to share the video with those of you who attended and those of you who've registered for the webinar. We have quite a few registrants. And other than that, if you have no other questions, thank you for joining us, and look out for other upcoming webinars, and wishing everybody a fantastic day. Thank you.